Welcome to the Deep Dive. We're here to guide you through the complex forces shaping our world. Today, we're really cutting through the noise of the global financial markets. We want to give you a clear, structured summary of what's, truly driving things.
Yeah, there's a lot to sift through.
Exactly. So our mission for you today is to unpack these latest global market movements. We've gone through, well, a mountain of financial news, economic calendars, market sentiment stuff. Think of this as your shortcut, connecting the dots between events that might seem separate, helping you get a quick but hopefully thorough grasp of today's financial landscape. We really want you to walk away feeling informed.
And what's really striking right now, I think, is just the sheer density of critical economic data, geopolitical events hitting the wires. Especially today, Thursday, September 11th, 2025. These aren't just headlines. They directly influence market sentiment and, crucially, central bank decisions. Our goal is to help you see the patterns, understand the why behind the market shifts, especially around inflation, interest rates, and investor emotions, which can be unpredictable.
Okay, so let's dive right in then. What's really dictating the mood in U.S. markets? It seems to be inflation data, right?
Absolutely. Inflation is front and center.
You might recall the Producer Price Index, the PPI report from yesterday, Wednesday the 10th. The headline was, well, quite a surprise, wasn't it?
It was a definite surprise.
The PPI actually fell 0.1% month over month. That's its first decline in 4 months, and they even revised July's figures down too.
That is a significant shift. And here's where it gets, well, really interesting.
Yeah.
It suggests companies might be hesitant to pass on higher costs, even with tariffs sort of lingering in the background.
So that strengthens the argument for Fed rate cuts, sooner rather than later.
For many, yes, it definitely adds fuel to that fire. But, how much weight does one PPI report really carry? That's the question.
That's an excellent point. It's just one piece.
Right. But PPI is a crucial upstream indicator. Parts of it feed into the calculation for the personal consumption expenditures, the PCE price index, which, as we know, is the Fed's preferred inflation gauge.
Okay, got it.
So a softer PPI does offer maybe a glimmer of hope on inflation. Analysts are certainly watching. Citigroup, for instance, put out a report noting inflationary pressures appear generally mild based on this PPI data.
And what are they suggesting?
They went as far as suggesting there's no real reason for the Fed to hold back from a 25 basis point cut in September. That's 0.25%, and maybe subsequent cuts too.
Wow, okay, so yesterday's PPI was a key signal, but today, Thursday, September 11th, the big one is the Consumer Price Index, CPI, out at 8:30 a.m. ET.
That's the main event today, yes. Directly impacts what consumers are actually paying.
So what are the expectations there?
For core CPI, so that's stripping out food and energy, the forecast is 0.3% month over month and 3.1% year over year for August.
Okay.
The overall CPI year over year is actually expected a bit higher at 2.9%. That's up from an earlier 2.7% forecast.
Right, and month over month.
Expected at 0.3%, also a tick higher than the previous 0.2% forecast. So this raises an important question.
Which is?
If the overall CPI is ticking up, even with that softer PPI yesterday, how might today's CPI number influence the Fed's meeting next week, the FOMC, September 16th and 17th?
Because the market's already betting heavily on a cut then, right?
Heavily. Pricing in that first cut, and maybe, 3 cuts by the end of the year? That's the general expectation right now.
And that's a critical piece of the puzzle,
Yeah.
especially when you add in the broader context. Like, the Fed relies on data, but what if the data itself gets questioned?
Exactly. We've seen the Labor Department's Inspector General looking into the Bureau of Labor Statistics, the BLS, for challenges in data collection.
And that huge downward revision to payrolls, 911,000 for the year to March, largest ever. Plus, July's data revised down significantly too.
Right, significant revisions. And then you have the politics angle. The Senate Banking Committee supported Milan's nomination to the Fed board. Full Senate vote, likely September 15th, just before the FOMC.
So, connect those dots for us. How do these data integrity worries and labor market shifts, plus a potential new board member, factor into the Fed's thinking?
Well, it adds a very complex layer. If the foundational data for their data-dependent approach is under scrutiny, it complicates their assessment.
Natural makes sense.
This uncertainty can definitely impact how reliable the market perceives their signals to be, regarding the pace and scale of potential cuts, adds another element of caution to an already tricky balancing act.
Okay. So with central banks navigating this sort of choppy data. Where are investors putting their money? Let's talk equities, U.S. stocks.
Right.
The S&P 500 hit another record high recently. NASDAQ saw slight gains. Dow was down a bit, though. But the real star, the engine behind this rally, seems to be AI stocks. Yeah, still.
Still AI, absolutely. And the performance of some individual players has been, well, spectacular.
Like Oracle yesterday.
Exactly. Oracle. Shares surged an incredible 36% yesterday, September 10th. Their biggest gains since, 1992?
Wow. That's huge. Push Larry Ellison briefly to world's richest person.
Briefly, yes. Fortune reportedly jumped $90 billion in a single day. It's staggering.
Name the reason.
A very bullish outlook for their cloud infrastructure business and this massive deal with OpenAI. $300 billion, 5 years, 4.5 gigawatts of data capacity.
Just enormous numbers. And others like NVIDIA gained too.
They did. It raises this fascinating question, though.
Is AI growing the whole pie or taking share from others?
Precisely. Is it expanding the tech sector overall, or are these gains coming at the expense of other cloud giants like Alphabet? You had UBS CEO Sergio Ramati talking about two economies.
Right, the traditional versus the AI tech-driven one.
Yeah. So the debate is this AI trade just operating on a completely different level, sort of immune to the real economy? Or is it just an acceleration phase, maybe like earlier tech booms, but maybe this time with new inflationary side effects?
How do we gauge the mood around all this? Sentiment indicators.
We often look at things like the CNN Fear and Greed Index. It acts like a thermometer for market sentiment.
How does that work?
It aggregates 7 indicators: market momentum, stock price strength, breadth put-call options, volatility, the VIX, the fear gauge, plus safe haven demand and junk bond demand.
And where would it likely sit now with the S&P strong, VIX around 15?
While those numbers strong, S&P, VIX relatively low, around 15.1, certainly suggest a lean towards the greed end of the spectrum, driven largely by these tech rallies, especially AI.
Okay, and while equities grab headlines, currencies are reacting too, right? Tied to the central bank stories.
Very much so. Take USD. It was pretty quiet ahead of the CPI data today, but the general view is it could climb toward $1.20.
Why is that?
Mostly due to that expected divergence we talked about. The Fed seen cutting rates, while the European Central Bank, the ECB, is expected to hold.
Makes the euro relatively more attractive.
Potentially, yes. Meanwhile, USD JPY is hovering around 147.44, and based on the prepared information, US dollar volatility could really spike on today's inflation data.
So what are the broader implications if that Fed ECB divergence really plays out?
Yeah.
For the dollar.
It's a crucial factor. If the Fed cuts and ECB holds, yeah, the euro looks relatively better for yield seekers, possibly fueling that euro USD climb. And given the dollar's global role, any big shift impacts trade, commodities, investor confidence everywhere. Today's CPI will either reinforce or challenge that dovish Fed expectation.
Yeah.
The dollar reaction could be pretty swift.
Okay, let's pivot now to some global headwinds, tailwinds outside the U.S. Europe first. The ECB has its rate decision today, too, September 11th, 8.15 a.m. ET.
That's right. And the expectation.
A hold.
Rates staying put. Yeah. Main rate likely staying at 2.15%, deposit facility at 2.00%, marginal lending at 2.40%. That's the consensus. Then we get the policy statement and Lagarde's press conference at 8.45 a.m. ET.
And this is happening against that backdrop of French political instability you mentioned.
Exactly. New Prime Minister, Sébastien Lecornu, faces big challenges. Budget cuts, getting parliamentary support. France has the widest deficit in the euro era right now.
You can see that in the bond market.
Definitely.
Right.
French 10-year bond spreads over German bonds are widening, meaning investors want more compensation for holding French debt. Around 82 basis points now. And Fitch Ratings updates France's credit rating tomorrow, September 12th.
So how do those French worries ripple out? Does it reinforce the ECB's caution?
Absolutely. That political and fiscal uncertainty is a significant regional headwind, impacts Eurozone stability overall, makes the ECB less likely to cut soon, even if some economies could use it, adds systemic risk.
Okay, and moving over to Asia, the Bank of Japan.
BOJ decision isn't until next week, September 19th. No hike expected then, but a Bloomberg survey shows 60% of economists now expect a hike by year-end.
Really? That's a shift.
It is. 36% are even betting on October. The drivers seem to be a pretty robust real economy in Japan, persistent inflation there, and maybe less uncertainty now around U.S. tariff policies.
And the implication for the yen?
Potentially significant strengthening against the dollar. Definitely something to watch closely in the USD-JPY pair if the BOJ does move towards normalization.
Okay, let's talk global trade. You mentioned tariffs. It seems like a real mixed bag right now.
It really is, both headwinds and tailwinds. Mexico, for instance, plans new tariffs up to 50% on cars, steel, textiles from China, and several Asian importers like South Korea, India.
Why are they doing that?
The stated reason is protecting about 320,000 jobs, but it also aligns Mexico more closely with U.S. trade policy, especially with the North American Trade Pact Review coming up.
But then you have the U.S. and Japan reducing tariffs.
Exactly. A deal to cut tariffs on vehicle and parts imports from 25% down to 15%. Nissan welcomed that, obviously.
So what does this all mean? Reducing some tariffs, introducing others, confusing for supply chains, prices.
It highlights this ongoing fragmentation of global trade. Mexico's move looks like strategic alignment with the U.S., maybe anticipating that trade pact review, pushing for regional supply chains, could raise costs from targeted Asian countries.
Well, the U.S.-Japan deal is de-escalation.
Right. Good for specific industries. The net effect is just more complexity. A recalibration of global manufacturing, distribution, could mean localized price hikes for some, new opportunities for others. It's messy.
And layered on top of all this, we can't ignore the geopolitical flashpoints.
Definitely not. They keep adding uncertainty. Yesterday, September 10th, Poland invoked NATO Article 4.
Why? What happened?
Russian drones apparently entered its airspace. Poland called it an intentional provocation, said there were 19 incursions, some originating from Belarus. Drones were shot down.
Any market reaction?
Yeah, some volatility in the Polish zloty and their stock index. A reminder of the risks simmering in Eastern Europe.
And elsewhere?
Middle East tensions remain high. Israeli PM Netanyahu warning of more targeted strikes. Saudi Arabia called for a global response after an attack on Doha. You're seeing Gulf states reevaluating security ties with the U.S., maybe looking east more.
These things always have spillover potential, don't they? Energy prices, risk appetite.
Absolutely. Even if they seem distant, they affect global flows and investor sentiment.
Okay. So as we look ahead, lots still happening. What else should people keep an eye on to stay informed?
Well, for a comprehensive view, investing.com's economic calendar is always a good resource. It gives a snapshot of upcoming events.
Any key dates after today we should highlight?
Sure. Tomorrow, Friday, September 12th, we get that Fitch Ratings update on France's credit rating. Could be market moving for the Eurozone.
Oh, yeah.
Then next week, Monday the 15th, the U.S. Senate vote on Milan's Fed nomination, followed by the big one, the U.S. FOMC meeting, Tuesday and Wednesday, the 16th and 17th.
And the Bank of Japan.
Their monetary policy decision wraps up the week, Thursday the 19th. So still plenty on the docket.
All right, so just to recap the major themes we've hit today.
Yeah, we've really dug into that ongoing inflation debate, the Fed's tricky balancing act, made trickier by data questions.
Right, and the incredible surge in AI stocks, creating that sort of two-speed economy feel.
Exactly. Plus the strategic dance of global trade and tariffs, that mixed picture there, and always those geopolitical undercurrents shaping things.
So connecting it all. Maybe a final thought for people to mull over.
Okay, here's something to consider. If we connect this to the bigger picture, this AI boom, right, it's spectacular, but it's proving to be inherently inflationary.
How so?
Just the massive demand it creates for high-powered chips, data centers, specialized infrastructure. It pushes up prices for those critical inputs.
Interesting point.
So the provocative thought is, how much longer can this AI economy operate seemingly immune to the pressures felt by the traditional economy? And what happens when those two worlds inevitably fully converge? When those AI-driven inflation pressures start bearing down on everything else?
The convergence point. Definitely something worth mulling over. Will the AI tailwind become an inflationary headwind for everyone?
Could be. Definitely something to watch.